Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to discuss the question, are we in a bubble? Now, obviously it's been well documented that both property and share markets are trading at almost all-time highs. And it's reasonable, or if not even arguably prudent, to really ask ourselves, are we in an asset price bubble? Because we know bubbles cannot grow forever. At some point, but all bubbles burst. So let's talk about the share market first, and then I'll talk about the Australian property market after that. Share markets around the world, including Australia, have been incredibly resilient throughout the pandemic. And in fact, that most markets, and that's certainly true for the Australian, the US and European markets, are trading at above pre-pandemic levels. And it probably shouldn't come to us as too much of a surprise, because really the size of government fiscal support in terms of quantitative easing and spending by the governments and grants and all those sorts of things has been certainly unprecedented. And obviously interest rates couldn't be much lower than what they are today. In terms of real interest rates with central banks, they're pretty close to zero, so they can't get much lower than that. So it shouldn't be a surprise that share markets have done well. But when we look to share markets, we see signs or examples of bubbles. And I think there's probably no better example than the listing of Rivian Automotive in the US. It listed on the NASDAQ. It listed on the 9th of November. And it raised $12 billion from investors. So that's how much cash they raised as a result of listing on the NASDAQ. And its current market cap, which is market valuation, is $110 billion, making it the fifth most valuable automotive manufacturer in the world, behind Volkswagen. Now, Volkswagen sells 2.8 million units, cars, trucks, etc. So, of course, it's a well-established and very valuable company. And to put it in context, Rivian is almost worth as much as CBA, which is Australia's largest or most valuable company on the ASX. Now, perhaps the most noteworthy thing about Rivian is that it hasn't manufactured one product. That's right, it hasn't even generated $1 of revenue, let alone profit. Remembering profit is what drives the value of a stock or a company rather than just revenue. Now, it's true that Amazon, which owns 20% of Rivian, has agreed to buy 100,000 electric trucks, and they expect those 100,000 trucks to be on the road by 2030, so over the next 9-ish or so years. But there is absolutely no conceivable way on earth that Rivian is worth $110 billion, particularly when it hasn't, as I said, hasn't manufactured one unit. And we know, the troubles that Tesla's had to deal with in terms of manufacturing. So, to value it at that point is just nothing short of insane. And it's true that, if you look wider in the US, that the tech companies have certainly contributed a lot to really US share market returns over the last 10 years. And in fact, the FanMag stocks, which are, the 6 stocks including Facebook, Amazon, Netflix, Google, which is Alphabet, Apple and Microsoft. Use that FanMag as an acronym, of course. Now account for 24% of the S&P 500 index in terms of value. The value of these companies, the aggregate value of these companies, is circa $8.5 trillion. And to put that in context, the whole of Japan's share market is worth $6 trillion. So they've certainly driven a lot of stock share market returns over the last 10 years, and they're certainly making up a very large, concentrated a large amount of value just in those 6 companies. It's also noteworthy, I think, to point out that with the rise of Tesla's share price, it joined the S&P 500 index in December 2020, and since joining has contributed about $500 billion in terms of value to that index over time. So when you look at what's driving performance in the US, you can certainly drag it back to just a handful of stocks, or at least attribute a lot of the gains to a handful of stocks. Now, it's important to point out that not all these stocks are valued like Rivian, with no connection with reality. That's Rivian, of course, and I think Tesla's the same. But some of these have very sound fundamentals. So you take Apple as an example. Apple took 38 years to reach a $1 trillion market valuation in 2018, about mid-2018. So 38 years to get to 1 trillion. It only took another 2 years to get to 2 trillion. So mid-2020, mid-last year, it reached 2 trillion. And it's currently worth $2.6 trillion. Now, you look at that valuation appreciation, you go, wow, that's crazy. But a lot of the growth has been driven by an improvement in underlying earnings, so profit, so it's fundamentally sound. And when you look at its PE ratio of 28 times, it's not implausible. And in fact, it's relatively easy to justify. So it's not a case of just saying, look, all tech stocks are overvalued, and therefore the US is overvalued. Now, we see the same sort of things going on in an Australian share market context as well, obviously to a much lesser extent in terms of valuations because our market is so small. But look, if you look at cloud-based accounting software provider Xero, it has a market cap of $22 billion. It recently reported a first half loss of $6.5 million in the 2022 financial year, so the first half of 2022 financial year. Which isn't a huge loss, but look, it's not making money, and it's valued at $22 billion. Now, throughout the presentation, Xero likes to talk about lifetime value of a customer, probably in a way to kind of justify their market valuation to try and keep the share price high. But really, investors really only need to be interested in profitability, of which Xero has none. But then if you contrast that to, say, BHP, it's trading at a forward PE ratio of 12 times, which is ridiculously low. Maybe, it's 50% lower than what it should be. Now, of course, it's tracked the fall in the iron ore price of recent. Iron ore price really fell sharply since August. And so that's had an impact on BHP share price, and so it should, but maybe not to this extent where it's trading at a forward PE of only 12 times. So again, there's patches in the Australian market where you go, oh, it's a bit of a bubble. And then there's patches where you go, well, it's still very good value. So let's turn our attention to the property market because it's been well documented about what's happened to property prices. And if you look at CoreLogic's home value index, we see that in the year to October 2021, houses in Sydney have appreciated by 30%, 26% for Brisbane and 20% for Melbourne. And while these share price increases are unsustainably high, I think it's important to really consider the medium-term performance because especially considering returns were negative in between 2017 and 2019, that 2-year period was kind of tumultuous. We had the federal election, lead up to the federal election, talking about negative gearing, those sorts of things, credit tightening, etc., etc. So when you have a look at the 5-year performance through to June 2021, now I use June 2021 because I'm using Real Estate Institute of Australia data, and the most recent data is for the June quarter. But when you look at that period, that 5-year period, that the price growth in Brisbane, Melbourne and Sydney has been between 5 and 7%. So Melbourne and Sydney closer to 7, Brisbane closer to 5. Which in both instances is below the long-term average. As I talked about a couple of weeks ago, there's a few commentators now suggesting that property prices in Australia will come off a bit, either a bit or 30%, according to some commentators. What I think is interesting is we have a look at sort of medium-term returns tend to be a good predictor of price falls. So what I did is I had a look at over the data since 1980, and in Melbourne, Sydney and Brisbane picked the biggest price drops in those capital cities, and then had a look at what was the price growth leading into that price drop. So here's what I found.
In the median house price in Sydney fell by about 15% between 2017 and 2019, so pretty recent. But the 5-year period leading into 2017, property prices rose by about 13% per annum, compounding on average over that 5-year period, so above median value for a sustained period of time. In Melbourne, the median house price dropped by about 11% over 2011-2012, so that's really around the GFC. The 2-year period prior to that, prices rose by 24% per annum, so 24%, 2 years of consecutive 24%, so that's pretty significant. And in Brisbane market's not very volatile, like the price doesn't jump around too much, but in 86, 87, so this is really around the 80s sort of share market crash, prices fell by about 8%, and the 5 years prior to that, prices rose 11%. So the conclusion is that if growth really needs to be above average for an extended period of time, let's say 2 to 5 years, for there to be a risk of a price correction. Given that property prices in Melbourne, Sydney and Brisbane over the last 12 months have merely been making up for a really poor period over the last 5 years, so negative returns in between 17 and 19, I think all that's happened is just a bit of mean reversion. And so long as prices don't grow by another 20% plus next year, then I think the chances of a price correction, or that we're in a price bubble, I think the risk is very, very low. And finally, let me talk about Bitcoin or crypto. It would be remiss of me not to mention crypto in a podcast about property price bubbles. It's noteworthy that the total value of Bitcoin is now worth $1.1 trillion US dollars, and the market value of all cryptocurrency is circa $2.6 trillion US, which is worth more than the entire Australian share market. So that's for a product, if you want to call it a product. Let's just call it decentralized currency or crypto. That's rarely used for anything other than speculation. So if you say, okay, this is a speculative asset and it's now worth more than Australia's entire share market, let's ask ourselves if that looks bubble-esque. I think the answer is a resounding absolutely yes. So a gentleman by the name of Rob Arnott is a US market fundamentalist, which means he believes in sort of US fundamentals or market fundamentals to drive returns. And he's a great commentator who I greatly respect. And in a recent interview, he's been talking about microbubbles. And his observation is that, for example, tech company valuations are not universally irrational. I mean, I spoke just recently or just before about Apple, for example, is a good example of that. Whereas in the dot-com bubble in the early 2000s, certainly valuations were almost universally overcooked. So instead, it just seems like certain stocks or assets like crypto are exhibiting bubble-like valuations, and this is what Arnott calls microbubbles. So we're not in a big bubble, but we have microbubbles. Now, it's kind of interesting to ask ourselves what's caused these bubbles, and of course it's difficult to really ascertain, but I suspect it's a combination of low interest rates and COVID lockdown/restrictions. So low interest rates means that people had more surplus cash because obviously the interest portion or interest bill, household interest bill has reduced. And because of COVID restrictions, it means that people have spent less money on travel and entertainment. So they're locked at home, they've got more money because of the interest rates, they're spending less money on other things. And as such, people have been willing to sort of gamble, take higher risk because as a result of this newfound money, in certain assets with the aim of generating quick returns. And according to some estimates coming out of the US, individual investors opened more than 10 million new brokerage accounts in 2020 last year in the US. So that's the most that's ever happened. And I think it lends support to the thesis that people have been at home, had more money in their bank, and thought, well, it's money I never had or never expected to have. I'll take a risk or take a punt, if you like. So it begs us to ask the question, aren't fundamentals important anymore? So what makes someone buy Tesla when it's trading at $1,100 per share, $1,100 per share? Using a fundamentals approach, you would have to make ridiculously implausible assumptions to justify that share price. So, for example, to justify that share price, Tesla would have to have a growth rate that's more than double what Amazon has produced over the next 5 to 10 years. Now, Amazon's a once-in-a-generation growth story, and what we're assuming here, or what we have to assume to justify the price, is that the growth is going to be more than double, which is kind of crazy and certainly a very risky proposition. So what people that buy into these microbubble assets, they're not influenced by fundamentals. They're not trying to compare earnings and PE ratios and all those sorts of things. What they're buying is the narrative, is the meme. Narratives like Elon Musk is a genius, and since all his wealth is tied to Tesla and SpaceX, well, he's got to make it work. And he's a genius, and there's no better incentive to make it work. Or that the price of Bitcoin will continue to rise, and I'm a clown if I don't jump on board. Or that zero might one day achieve some scale, but probably more it's just about the future momentum of price, and that I should jump on board because this thing's going to keep rising because, look, I thought it was expensive at $20 and now it's trading at $130 a share. At some point, I've just got to jump on board. So it's really the narrative that's guiding these or adding to these micro bubbles rather than anything that's fundamental. So, of course, the question we need to then ask is, when will the micro bubbles burst? And when contemplating this question, I think there's really two important observations. The first one is that bubbles can last longer and go higher than any reasonable person could imagine. So, and as the saying goes, the market can remain irrational far longer than you can remain solvent. So you most definitely shouldn't short or take a bet against the bubble and short the asset. Because they can run longer and deeper than you can imagine. And, we could be here and 2 or 3 times later and Bitcoin's still very high. And secondly, whatever ends a bubble tends to come as a surprise. In fact, by definition, it has to be a surprise. Now, there's a few factors that the market would be unsurprised about that are already reflected in prices, like higher inflation, higher interest rates, end of COVID, central bank tapering in terms of QE, and those sorts of things. Those sorts of things are unlikely when they occur to impact or affect a bubble or bubble kind of prices. The catalyst, whatever it is by definition, it has to be something that's unpredictable today. The only alternative to the unpredictability is that sometimes gravity is just what ends bubbles. So prices or valuations get so high that they start to become unpalatable to almost everyone. It's kind of, what goes up must come down kind of methodology. And in the early 2000s, the tech bubble that happened in the early 2000s was probably a good case in point. To date, no one's really been able to identify the one thing or things that caused the dot-com bubble to burst. It was merely just gravity. Prices just got too high. So as a wrap-up then, it seems like we're not in a bubble. There certainly are micro bubbles, so asset bubbles or stock bubbles that are asset or stock specific. And if you're investing in those stocks, then you better have an exit strategy. That is, you've got to have an exit strategy when you're going to sell. Take your profit before the bubble burst, because it will. No one knows when it's going to happen. But markets can turn very quickly. It will burst at some point. So just make sure that you're within your investment strategy, you've got a strategy that's going to address that risk. Or alternatively, the approach that I much prefer is to invest in a way, so using methodologies that avoid exposure to these micro bubble assets. And perhaps the most important theme of this podcast today is that there's still some excellent investment opportunities in all markets. Don't assume just because the share market is trading at all-time highs that everything is overvalued. That would be a poor assumption. Okay, that's it for me for this week. Until next week, bye for now.